Welcome back, friends. In this video, I'm going to be sharing something with you that a lot of people don't realize. In this video, we're going to talk about why your company should be investing in purchasing. We are talking about purchasing. And I'm going to start with a very simple scenario that a lot of businesses go through. So imagine you're the leader of an organization and you're operating your business, and this year you make a little bit of profit. And so as the leader of this organization, you want to take a piece of that profit and reinvest it back into your business. So here's the question you're going to ask yourself. Where can I put this money in my business to have the best return on investment? Many businesses will first look to invest in sales or operations. However, my recommendation is a little bit different. I think that the first place a business should look to put their investment dollars is the purchasing department. The reason I'm making this video is that so few businesses even consider this. Purchasing is often the last place people look to invest in. And I'm going to show you mathematically why it makes sense to be investing in purchasing. For a lot of businesses that are out there, the purchasing department consists of the accounts payables person in the accounting department. So you might have an individual who creates purchase orders and authorizes purchases. If this sounds like your company, that purchasing role can be expanded dramatically. Purchasing has developed into a whole field of study called supply chain management. It's no longer just an accounting role, it is a whole separate department that can be a strategic role for your organization. Now, in order to create a supply chain management department, it takes investment. You need to hire experts in the field, you need to train your employees, have the right software, bring in best practices, and that all costs money. The reason why few businesses are investing in supply chain management is because that department does not generate revenue. So if you're a leader of an organization and you're trying to make a return on investment decision, it's difficult to invest in a department that's not directly linked to revenue. So sales and operations, you can directly link to generating revenue. Whereas for purchasing, a lot of people think of that as a cost center. It's just extra overhead. But if you look a little bit closer, what you'll actually find is that supply chain management is a significant driver for your company's profits. And in fact, supply chain management can become a source of your organization's competitive advantage. You can see this concept through something we call DuPont Analysis. Now, last week I talked about the DuPont equation, and the great insight from the DuPont equation is that you can start with an accounting ratio and drill down to better understand what's driving that accounting ratio. Well, DuPont Analysis just takes that concept further. And we can continue to drill down to better understand what is driving our organizations. I'm going to show you how this works. We're going to start with return on assets, which is our good friend, productivity. Return on assets is net income over assets. The question is, what is driving ROA? ROA is profit margin times asset turnover. Two more accounting ratios. That provides more understanding, but we can go even further. Net income comes from revenue minus cost of goods sold. Assets is a combination of current assets and capital assets. And so what you start to see is that you can model your entire organization with these little boxes. This allows you to see how changes in each box impacts your organization's productivity. We are going to perform a couple of examples. Assume you decide to invest in sales. In your cost-benefit analysis, you determine that sales will increase by 5%. If sales increases by 5%, That means your cost of goods sold also has to increase by 5%. By the time that 5% trickles back to return on assets, you likely have about a 3% increase in productivity, depending on your assumptions. Now imagine the different example of investing in purchasing. Purchasing does not impact sales, but it impacts 3 of these other boxes: cost of goods sold, current assets, and capital assets. So if you are able to decrease your purchasing cost by 5%, you are looking at double-digit increases in productivity. That is a massive difference. And this does not have to just be about purchasing things cheaper. Making better purchases could also mean getting better quality or more value, which could also increase productivity. Please don't misunderstand me here. Sales is obviously important. I've made videos in the past on how important sales is for generating revenue. My point is that there are too many businesses out there that are investing disproportionately in their sales department and forgetting about looking at purchasing. Purchasing is a department where you could make really easy investments that would ramp up the productivity of your organization. Let's bring this back to accounting. If you are an accountant, you have the ability to have these types of insights. I mean, you look at accounting ratios every day. You understand things like DuPont Analysis, and you can go to your leaders and make recommendations on what types of things make better return on investment. That is the power of accounting. Just with what we talked about today, I mean, we are talking about massive gains in productivity. So if all of us did this for our own organizations, we're not just supercharging our own businesses, we could supercharge the economy. So these types of insights are the unique ability that accountants can bring to their organization. Now I want to hear from you. If you think that supply chain management is important, go ahead and leave that comment down below. Let me know what you think. And if you like this video, if you found it helpful, click on that subscribe button. The best way to supercharge a business is through accounting and corporate finance, and I release a new video every week. So come back and check out next week's video.